Hello everyone and welcome back to another video by Reut-Capital. Today we will talk about assessing and growing your net worth. You might find plenty of resources online that state how much your net worth should be as a function of your age, but not many really talk about the contents of your net worth and how each asset in your net worth plays a unique role for you. As we approach the end of the year, I encourage each and every one of you to take a half an hour out of your busy day to take a snapshot of your finances. Now is a great time to do that as it will allow you to plan your next financial move for the new year. What do I mean by a snapshot? It's not merely checking how much money is in your checking account or what my vested stock portfolio value is. It's a bird's eye view of all your assets and liabilities put together and sort of getting an idea of where the majority of your net worth lies. I'll explain more with examples in the next slides. But before we get started, a quick disclaimer from my lawyer. I'm not an investment advisor, and this presentation is provided for educational purposes only. All metrics mentioned are rules of thumb, and each investment involves different degrees of risk. Do not invest your money on my recommendations alone. Consult a professional advisor. All right, let's get started. Let's start with the definition of net worth. I have pasted here kind of a formal definition of net worth, but what it simply means is it's the sum of all your assets that you own minus the liabilities that you owe. So, for example, a checking account, all the money in your checking account can be considered as an asset because usually you don't have any liabilities tied to it. If you take the example of a home, your primary home, the current value of your primary home minus the pending loan can be added to your net worth, and so on and so forth. So let's start with some examples. The first one, this guy's name is Concentrated Chris. He's a hardworking individual who has a family and a high paying job. He's very good at his job and extremely busy with his work during the day. And off work, he's busy with his family. He has the most common accounts any individual on a W-2 has. Now, you will see the table here. I have listed a bunch of common accounts and the value and the percentage of his total net worth. So, for example, 38% of his total net worth is the vested employer stock, 19% is the primary home, and so on and so forth. Now, it's important that we focus on the percentage and not the raw value because the raw value could be misleading versus a percentage can give you a fair distribution of where you are. So, what's good about this, right? If somebody has a portfolio like this, he has some diversification going on. He knows he has different accounts. But if you look at it more holistically, the majority of this pie is firstly liquid, which is a good thing. It is tax heavy because when you sell employer stock, you pay tax. When you sell 401k, you pay tax. Even though it is tax friendly in the front end, you do end up paying tax when you exit. So it is extremely tax heavy. Majority of his net worth here is extremely tax heavy. And thirdly, it is volatile. Ultimately, these are tied to the stock market. And if stock market, as we know, is volatile in nature, majority of your net worth is exposed to that volatility. So what could Chris do? Let's look at the next example. He could add few more accounts. So Ticker Tom, he learns from Chris and he's like, okay, I've heard about all these other plans that are out there. Let me open a brokerage account. Let me open a Roth IRA. I've heard so many good things about it. Let me go buy some gold from Costco. I have heard about 529 educational plans for my kids. So he goes ahead and opens these accounts. So now there's a lot more color in his pie chart. There's a lot more distribution in his net worth. But again, if you step back and look at it, even though he has multiple accounts, the majority of this pie is again, the good thing is it is liquid. There are some tax friendly accounts. like the Roth IRA and the 529 plan. These are tax-friendly accounts, but they are volatile. Ultimately, if these plans need to grow, they need to be invested in the stock market. So they are volatile in nature, and they are all tied to the stock market. So that could be a big con for the majority of the pie. So, having said that, again, even Tom wouldn't want the majority of his net worth be exposed to the stock market, even though it gives him good tax benefits, even though he can liquidate it whenever he wants. It's all tied to the stock market, which is not good. So, what can you do, right? Maybe you could increase some real estate. Maybe you could have more instead of 19% in your real estate net worth, you could have a little bit more. So, let's look at the next example. Locked up Logan. So he learns from Tom. He's like, okay, so many accounts is ultimately, I am still exposed to the stock market. I need to add some stability. Maybe I will increase my real estate percentage as part of my net worth. So he decides to pay down his mortgage. He hears these neat tricks and tips where you pay a little extra every month, and you pay bi-weekly and whatnot, and you really start to pay down that loan. Let's see how his portfolio looks like before. Now at least the majority of the pie is reduced. It was almost three-fourth, and now it is half, which is liquid, some tax-friendly accounts, volatile, and tied to the stock market. And the second part is he's increased his percentage in real estate. But unfortunately, he's done that by paying down his primary home. Why I am saying unfortunately? Well, that's because when you pay down your house, it's considered dead equity. What I mean by dead equity is the money that you pay as your mortgage is buried into the walls of the home. You essentially cannot do anything with it unless you sell your house, or to buy maybe a new primary residence, or you take a home equity line of credit, which is ultimately a loan again against your house. And if you do that, you're back to square one. You again have a loan which you need to repay. There is no cash flow. Your primary paying down your primary residence does not produce cash flow. And missed opportunity cost. So some may say I may be debt free, or my mortgage will be paid out 10 years earlier than before. That is true, or you'll save a bunch of interest. But if you were to invest that extra cash into the stock market or any other opportunities, I am sure you'll come out way far ahead than the gains from paying off your house. They will look really insignificant as compared to, the interest you will earn somewhere else. So just keep that in mind, that paying down your house is not always a good thing unless it gives you that peace of mind and you sleep well at night. That's a personal preference. So that's why this guy's name is Locked Up Logan. He decided to increase his primary home equity and more percentage in real estate, but then he has locked himself up in his own house. Neither does his house cash flow. He's missed out on opportunity cost somewhere else, and he's basically tied up in his own house. So what could be next? So the next example is diverse Dana. She learns from all these guys. She learns from Chris, she learns from Tom, she learns from Logan, and she decides to add some more pop and some more color to her multi-asset portfolio. And she decides over a time frame of 4 or 5 years that she will get into some sort of real estate. So she does one or two single family homes, she does one or two multi-family homes or projects, and then she has all the other plans that everyone else had. So now let's look at how her portfolio looks. Again, the yellow part is the kind of the volatile stock market, which is also liquid. So the same stuff, it's liquid, some tax-friendly accounts, it's volatile and tied to the stock market. The second part is her primary home, which, as we discussed, is dead equity, does not cash flow, and missed opportunity cost. The third part are the real estate investments that she did. What is good about this? It is a second source of income. Now, there was a study recently where one of the biggest regrets for folks who were in their mid 40s was to not have a second source of income or a passive income stream. Likely people in their mid 40s have, been in the workforce for like 20 years. They're probably at the peak of their careers. But then you see, they realize that time is the ultimate asset. And if you stop giving time to your W2, your W2 will stop paying you. Your company will stop paying you. And when you realize that, you feel, okay, maybe there is a need for a secondary source of income. And that's where investments, alternative investments help. So real estate is a great source of secondary income or passive income. As you know, it cash flows. It is tax friendly. I did another video where I discussed, the benefits that you get from passive real estate, but it is fairly illiquid, um, which is the nature of real estate. You cannot liquidate it. If you need the money tomorrow, you will not get it. It will take some time. It may take 6 months. It may take 4 months. But if you have some portion of your portfolio liquid, it's okay to have some portion of your portfolio illiquid. The idea is to have a fair distribution amongst these classes. I might have missed some assets, like if you own a business, then you can go ahead and get that balance sheet and add its worth to the pie chart. Or if you own bonds or if you have cash value from life insurance, by all means, you could add those to this pie. Again, the idea is to have the right balance of risk, liquidity, growth, and cash flow to your portfolio. I'll let you guys do this exercise and let me know in the comments or offline your thoughts about your pie chart and how you would like it to shape for the next year and every year after that. Thanks for watching until the end. Like always, subscribe to the channel and hit the like button if you don't so you don't miss this content. I'll see you in the next one. Bye.